Hello traders, welcome to the third module of the Advanced Technical Analysis course, Chart Patterns. On this lesson we're going to go through all the basic chart patterns you need to learn. We're going to start with triangles. And there are three basic triangle shapes. Symmetrical triangle, and these are formed when price makes both lower highs and higher lows. And because of its shape, these triangles can be either a continuation or a reversal pattern. This is how they look like. As you can see, we are both contracting up and down, which means that both the bearish and the bullish pressure are equal. We cannot know for sure if we are going to break to the upside or to the downside, giving us either a bullish or a bearish signal. The second basic triangle shape is the ascending triangle, and these are formed by a flat top or equal highs and higher lows. This triangle is a bullish pattern that can be a continuation in an up move or a reversal at support on a down move. Here's how they look like. As you can see here, we are in a down move and we are making higher lows and a flat top. This is a very strong reversal pattern at the end of a down move at a support zone. And if we are in an up move and we see that we are making higher lows and a flat top, you can wait for the breakout to trade the continuation of the trend and go long on the asset that you are analyzing. And the third basic triangle shape is the descending triangle, and these are formed by a flat bottom or equal lows and higher highs. This triangle is a bearish pattern that can be a continuation in a down move or a reversal at resistance in an up move. And this is how they look like. As you can see here, in a down move, if we continue to make lower highs but a flat bottom, this means that the bearish pressure is still here and is going to overcome with the bullish pressure that we have encountered at this area of support, and eventually we will break to the downside, giving us a continuation signal. But in an up move, it is the opposite. We are making lower highs, which means that we have encountered a strong bearish pressure at this area of resistance, but we still have some bullish pressure that keeps maintaining these flat tops. But eventually this triangle formation is going to give us a reversal signal to short or to go short on the asset that we are analyzing. And this is why chart patterns are important, because they repeat themselves and it is easy to predict future price action. We just need to have patience and wait for the breakout in order to trade them. The second kind of basic chart patterns that we are going to learn are wedges. And there are two basic shapes of wedges. The first one is the rising wedge, and these are formed with higher highs and higher lows, and they are bearish signals. In an uptrend they are reversal patterns, and in a downtrend they are continuation patterns. Here's how they look like. As you can see, in both cases we are making higher highs and higher lows, but if we are in an up move, this will be a reversal pattern, and if we are in a down move, this will be a continuation pattern. And in both cases they are bearish signals, and in both cases we are going to wait for the breakout of the lower line of the wedge for us to go short on the asset. And the second basic shape of wedge is the falling wedge. These are formed by lower lows and lower highs and are bullish signals. In a downtrend this pattern is a reversal signal, and in an uptrend it is a continuation signal. And this is how they look like. As you can see, in both cases we are making lower highs and lower lows, but if we are in an uptrend, this is going to be a continuation pattern, because this will be a small correction before the actual move continues. And in a down move it will be a reversal pattern, and in both cases it will be a signal to go long on the asset. And the third kind of basic chart patterns we are going to learn are flags. And flags have one shape and are always continuation patterns. These patterns usually form when there's a sharp directional move, and after the move we usually see some sideways price action before continuing on the direction of the move. This sideways price action is called a flag, and the actual directional move is the pole of the flag. And this is called a flag. In both cases it's called a flag, and you can have flat flags or have counter directional flags just like this one. In both cases You need to wait for the breakout of the flag in the direction of the move for you to be able to trade it. In another module, we will teach you exactly how to trade it and exactly how to calculate the targets for you to be able to profitably trade them. But in this lesson, we will only teach you the actual pattern so you get comfortable with the idea of how to trade them.